2026 marks a historic shift. Regular people can now access opportunities once locked behind millionaire-only walls. Fractional investing, AI platforms, micro real estate. The barriers are gone. Warren Buffett started with $114 at 11. Bezos convinced 22 people to give $10,000 each. Musk bet everything on Tesla when everyone thought he was crazy. They understood it's never about how much you start with, it's where you put it. This isn't get rich quick. It's understanding where the world is moving and positioning yourself strategically, even with just $100. Why 2026 changes everything. Traditional barriers have vanished. Platforms like Robinhood and Webull let you buy 0.01 shares of Google. Retail investors now account for 23% of equity trading, up from 10% a decade ago. We're at critical inflection points, AI accelerating across sectors, renewable energy achieving cost parity, robotics entering everyday life. Plus, the global economy is entering a supercycle in commodities, tech infrastructure, and energy transition. $100 matters. Not because it makes you instantly rich, but because it teaches you how money works, how markets move, and how wealth compounds. Every billionaire started with their first dollar. Let's dive into the 9 smartest ways to invest $100 in 2026. Category 1. Fractional stocks in dominant companies. 10 years ago, buying Apple meant needing $105 for one share. Today, it's over $200. With fractional investing, you buy exactly $100 worth regardless of share price. The Magnificent Seven, Apple, Microsoft, Google, Amazon, Meta, Tesla, Nvidia delivered average annual returns of 28% over the past decade. Compare that to the S&P 500's 13%. Smart strategy: split $100 across 3 to 5 companies you've researched. Focus on AI infrastructure providers, Nvidia's chip dominance, Microsoft's AI integration, Google's DeepMind breakthroughs. Risk is relatively low. These are profitable giants with massive cash reserves. Growth might be slower, but you're building ownership habits and learning how markets work. Every platform offers fractional shares with zero commission now. Category 2. The AI revolution. AI will add $13 trillion to global GDP within a decade, according to Goldman Sachs and McKinsey. This is infrastructure being built in real time. Invest through AI-focused ETFs like Global XAI and Technology, AIQ or iShares Robotics, and AI IRBO. With $100, you're instantly diversified across 50 Midas 100 companies spanning chips, platforms, and applications. These ETFs average 32% annual returns over 3 years. Yes, there's volatility and regulatory risk, but AI is integrating into healthcare, finance, education, manufacturing, every industry. If AI is the most important technology since electricity, having exposure isn't speculation, it's strategic positioning for the defining investment theme of your lifetime. Category 3. Renewable energy. This isn't politics, it's economics. Renewable energy became the cheapest form of new electricity in almost every major market. When something is both greener and cheaper, adoption explodes. The IEA projects renewable capacity will grow 2.5x by 2030, a $4 trillion restructuring of global energy. Invest through Invesco's solar ETF, TAN, NextEra Energy, or battery tech companies. The Inflation Reduction Act allocated $370 billion toward clean energy. Europe's Green Deal is larger. Risk includes volatility and political sensitivity, but by 2050, renewables will provide 70 to 90% of global electricity. The companies building that infrastructure will capture immense value. Category 4. Robotics and automation. The global robotics market will grow from $75 billion 2024 to $218 billion by 2030, 20% annual growth. We're at the very beginning. Current robot density remains remarkably low even in developed countries. Invest through Robo Global ETF, Robo or Global X Robotics, boats holding companies like Intuitive Surgical, Keyence, and ABB. Robotics is expanding beyond manufacturing into warehousing, delivery, agriculture, healthcare, and humanoid robots. Labor costs are rising globally. Worker shortages intensify. Robots become more cost-effective yearly. Intuitive Surgical stock has grown 10,000% since 2000, and the commercialization is accelerating. Category 5. Index funds. The boring winner. Warren Buffett's advice for most people: buy an S&P 500 index fund. He's instructing 90% of his wife's inheritance to go there. The S&P 500 delivered 10% average annual returns over 90 years, through depressions, crashes, recessions, everything. Do the math: $100 becomes $260 in 10 years. $673 in 20, $1,745 in 30. But invest $100 monthly for 30 years at 10% returns? You'd accumulate over $226,000 from just $36,000 in contributions. Start with Vanguard's VOO, Fidelity's FNILX, Zero Fees, or Schwab's SWPPX. The boring choice is often the brilliant choice. Diversified, low cost, historically reliable. Category 6. Invest in yourself. $100 developing a valuable skill can generate returns no stock can match. The right skill increases your income by thousands annually. That's a return that would make hedge funds jealous. High-value skills under $100. Digital marketing. Businesses desperately need online marketing help. Freelancers charge $1,000, $5,000 monthly per client. Coding. Entry-level developers earn $60-70K. Experienced ones exceed $100K. Learn through Codecademy or free Codecamp. Video editing. With YouTube, TikTok, and corporate content exploding, editors charge $5,200/hour. Copywriting. Companies pay thousands for landing pages and email sequences. Data analysis. Organizations need insights from their data. Excel and Python courses cost under $50. A stock might earn 10 to 20%. That's $10.20. A skill landing one $500 freelance client, 500% return. If it increases your salary $10,000 yearly, 10,000% return. Skills only appreciate. They compound, they create income that creates capital, that creates wealth. Category 7. Real estate through REITs. You can't buy property with $100, but through real estate investment trusts, REITs, you can own pieces of apartment buildings, warehouses, cell towers, and data centers. REITs delivered 11% average annual returns over 50 years, slightly beating the S&P 500. By law, they distribute 90% of income as dividends. Invest in individual REITs like Prologis, Logistics, American Tower, Cell Towers, or Realty Income, monthly dividends, or buy REIT ETFs like Vanguard Real Estate, VNQ, for instant diversification across 160 plus REITs. Risk includes interest rate sensitivity, but REITs offer real assets generating cash flow with stock-like liquidity. You're earning rental income without being a landlord. Category 8. Startup investing platforms. Until recently, startup investing was restricted to millionaires. The Jobs Act changed that. Now platforms like Start Engine, WeFunder, and Republic let you invest $100 in early-stage companies. Be clear-eyed. 90% of startups fail. Your $100 could become zero, but successful startups deliver astronomical returns. Early Facebook, Google, Amazon investors saw thousands of % returns. Treat this as high-risk, small allocation. Look for startups with real revenue, experienced teams, clear paths to profitability, and reasonable valuations. Don't invest what you can't lose. This isn't just about returns. It's supporting innovation and accessing opportunities unavailable to previous generations. Category 9. Cryptocurrency. The intelligent approach. Bitcoin has existed 16 years, growing from worthless to over $1 trillion market cap. BlackRock, Fidelity, and JP Morgan now offer Bitcoin products. The SEC approved Bitcoin ETFs. Data-driven case: $100 in Bitcoin in 2015 would be worth over $15,000 today, despite extreme volatility. Intelligent approach: treat crypto as 1 to 5% of your portfolio. Allocate $10.25 of your $100 to Bitcoin or Ethereum through Coinbase or Bitcoin ETFs like IBIT or FBTC. Put the majority in stable investments. Avoid obscure coins promising massive returns. The space is filled with scams. Cryptocurrency is extremely volatile, but dismissing it entirely might be a mistake as major institutions build infrastructure around digital assets. Accept the volatility. Understand what you're buying. Don't invest more than you can lose. Never make decisions based on social media hype. Lessons from billionaires. Universal principles successful investors share. Patience is non-negotiable. Wealth compounds over years and decades. The longer you hold quality investments, the more you benefit. Understand what you own. Don't invest because someone online said so. Research, learn, decide. Volatility is normal. Markets fluctuate. Successful investors don't panic. They see downturns as opportunities. Consistency beats timing. Regular investing outperforms trying to time perfect lows and highs. Dollar cost averaging works. Investing the same amount regularly means buying more shares when prices are low, fewer when high. Compounding is magical. Einstein called it the eighth wonder. Small amounts invested consistently create surprising results. Control what you can. You can't control the market. You can control how much you invest, what you choose, how long you hold, and your discipline. Every billionaire investor has experienced massive losses. Buffett lost billions in 2008. Musk nearly went bankrupt. The difference isn't that they never lost, it's that they learned, adapted, and continued. Your next move. We've covered 9 approaches: fractional stocks, AI ETFs, renewable energy, robotics, index funds, skills, REITs, startups, and crypto. Each has different risk profiles and returns. The question isn't, which is objectively best? It's which aligns with your goals, risk tolerance, and interests. Want simplicity and reliability? Say S&P 500 Index Fund. Excited about emerging tech, AI or robotics ETFs? Want immediate income impact? Invest in skills. Seeking diversification? Split across multiple categories. Here's the truth. $100 won't change your life by itself, but learning to invest, understanding how wealth builds, developing financial discipline, and starting the journey that absolutely can change everything. The best time to start was yesterday. The second best time is right now. Your financial future isn't determined by where you start. It's determined by whether you start at all.